This video introduces the idea of capital cost allowance as a deduction from income. Students should be able to identify common CCA classes and perform calculations to determine closing undepreciated capital cost balances for a tax year, as well as the amount of capital cost allowance to deduct for several types of assets. Students should be able to understand, define, and determine recapture or terminal losses. Here are some of the learning objectives for this video. Upon completion, you should be able to understand what capital cost allowance or CCA is and differentiate between CCA and depreciation for accounting purposes, understand the general rules for the determination of CCA, identify common CCA classes, and also determine which class an asset goes into, calculate capital cost allowance using the schedule, and calculate closing undepreciated capital cost or UCC balances. Before we begin our discussion, let's keep in mind where this chapter figures into our final calculation of net income for tax purposes. We're focusing here on one very specific deduction from income or loss from business. So we're still in either Part A, or if we happen to have a business loss, here in Part D. The capital cost or CCA deduction from business income is effectively the expensing of the cost of a long-lived or capital asset over a period of time for tax purposes. For accounting purposes, we use the terms amortization or depreciation to reflect the deduction of this expense over the estimated useful life of the assets. Now, there are some notable differences between CCA and accounting amortization. The rates that are used for depreciation for accounting purposes tend to be based on the estimated useful life of that asset. Now, these estimates could potentially vary based on management's experience and the type of asset, a whole number of reasons. For CCA, the rates are prescribed in the Income Tax Act, and they have to be used to determine the deduction. They have to be used. There's no room for interpretation here. Now, the method that's used, again, when you're looking at accounting, you have a choice as an accountant. You can choose whatever method you want to use, and those methods could be, as you recall, straight line, units of production, double declining balance, for example. Now for CCA, there isn't a choice. Again, the methodology that's going to be used is prescribed in the Income Tax Act. So there is no option here. There's no room for judgment. Generally, what we're looking at is declining balance. However, once in a while, you'll see a class of assets that has straight line as the methodology. Now, what about the deduction in the year a capital asset is actually purchased? Now, for accounting purposes, the accountant has a choice, and they generally choose to prorate the amount of amortization that's taken in a year based on whenever they purchased it, which makes sense. Now, for CCA, irrespective of when the asset was purchased, a deduction equivalent to half of the annual deduction that you would otherwise calculate is almost always taken. This attempts to account for the idea that assets are likely purchased throughout the year on average. This is generally referred to as something called the half-year rule, and we'll talk more about it later on in the video. You might be familiar with many of the terms relating to capital assets for accounting purposes. I've attempted to highlight some of the major differences in terminology for tax purposes so that we're all speaking the same language. For accounting, when a capital asset is purchased, we refer to whatever we paid for it as the acquisition cost. For tax purposes, we use the term capital costs. This indicates all the laid down costs for the asset, thus the term capital cost allowance. We've already touched on how depreciation expense for accounting is called capital cost allowance for tax, right here. But another important difference that we haven't really touched on yet is net book value. So net book value for accounting purposes, the net book value of an asset, versus the undepreciated capital cost for tax purposes. Now, you'll recall from accounting, I hope, that the net book value of an asset is the acquisition cost less the accumulated depreciation up to that point. So if you're a few years into the life of the asset, you're still going to take a look at what did that asset cost, and then you would deduct any accumulated depreciation taken up to that point to arrive at the net book value. Now, the undepreciated capital cost, or UCC, is very similar in that it's going to be the original capital cost minus any CCA taken to date. UCC is a little different though, as similar assets tend to be grouped into pools, but we're going to discuss that shortly. To deduct CCA in respect of an asset, the asset actually has to be owned by the business and be used by the business for the purposes of earning income. This means that CCA on any assets the business owns that are not actually used in operations of the business can't be deducted. I think this makes sense. Expenses were defined as those costs incurred to earn a profit. If the business doesn't actually use those assets, they're not employed in any profit earning, and therefore no deduction for the business can be made. So some other mechanics of how the CCA system work are this. All similar assets are pooled into various classes. Each class is going to have a specific rate that is prescribed by the Income Tax Act to determine the amount of the deduction. A CCA is a discretionary deduction, which means that the taxpayer may claim any amount for CCA between 0 and the maximum calculated amount for that pool. If 0 CCA is claimed for the year, in the following year, the CCA deduction is calculated as normal. You can't, for example, deduct 2 years worth of CCA in the following year if you didn't deduct any in the prior year. Let's talk about these pools. The Capital Cost Allowance system, rather than calculate CCA on each individual asset, groups similar types of assets into various defined classes or pools. For example, all office furniture is pooled together into one Class 8 pool. Each of these pools has an associated depreciation rate prescribed by the Income Tax Act and a method which is usually the declining balance method. Note this is not the double declining balance method you may be familiar with from accounting. The CCA deduction is usually calculated on the total pool balance rather than on individual assets. This makes the calculation a lot easier when a business has many assets. These are some of the more common CCA classes that are used. They form the basis of most of the questions I'll be asking you here in Accounting 240, meaning that you're unlikely to encounter any other classes on exams. The first class I want to talk about is Class 1, which is buildings, and they use a 4% declining balance rate. General equipment like furniture, photocopiers, phones, some equipment, etc. is in Class 8. This has a 20% declining balance rate. I would say that if you're in doubt and you can't figure out where something goes, you should throw it in the Class 8 pool and see if it swims. Class 10 is where automobiles get pooled at a 30% declining balance, as long as they're not classified as Class 10.1 luxury automobiles. Now I'll talk about the differences between these two classes soon. Rates and methods are the same, but Class 10.1 has all sorts of fancy little rules. Now computers is the last thing I'll talk about, and they fall into Class 50, which has a fairly high 55% declining balance rate. This course is also going to touch on Class 12 assets, which have a couple strange rules associated with them. Now, Class 12 includes small tools, computer application software, and the rate here is a 100% declining balance, effectively meaning you would write off the entire balance in the year of purchase. Now, the assets that are included are some small tools, various instruments, kitchen utensils, as long as they cost less than $500. This also includes linen, uniforms, chinaware, library books, and rental costumes. Now, computer application software is scoped into this category as well, and application software consists of things that, not system software per se. System software would come with your computer and would be operating software like Windows or something along those lines. Here we're looking at application software, which is Microsoft Word, Excel, etc., things like that. So it's important to distinguish between the two. Now, with Class 12, we have something called the half-year rule, and I'm going to elaborate on that in its own separate space later on. But for now, you just need to have sort of the generalities of the Class 12 assets. Let's talk about the difference between Class 10 and Class 10.1 assets. We'll start with Class 10. Now, this pool includes most vehicles, such as vans, trailers, various delivery trucks, etc. It also includes passenger vehicles. This is just like regular cars that you and I know, right? Just a Ford Taurus or something like that. But in order to be in the Class 10 pool, the vehicle has to cost less than $30,000 before tax. The rate for the pool is 30% declining balance, except of course in the year of acquisition. There is no limit or cap to the capital cost to add to the pool, except that any passenger vehicles costing over $30,000 must be added to a separate Class 10.1 and therefore can't actually be added to Class 10. Does that make sense? I hope that makes sense. Weird, right? Now let's talk about Class 10.1. Now, Class 10.1 includes passenger vehicles, right? Any sort of civilian automobile that costs over $30,000. Under $30,000 would go in Class 10. This class does not include anything like trucks or buses or delivery vehicles or anything else. Just quote-unquote luxury vehicles costing more than 30 grand. So the limit that can be added to this pool is $30,000 plus sales tax. Doesn't matter what the cost of the car is. If the car is $80,000, $90,000, the most that can go into the pool is $30,000 plus any sales tax. Again, if the car is less than $30,000 before tax, it would go into a larger Class 10 pool. So the rate again is 30%, and the half-year rule would apply in the year of purchase. Each asset in this class is going to have its own separate pool. You can never have more than one car in this pool, right? Each luxury vehicle over $30,000 will be in its own separate 10.1. Usually you don't have that many, right? But if you do have more than one, it's in its own pool. When these cars are disposed of, there is no recapture generated. Now this is unique, but we don't know what recapture is yet, so don't stress out about it too much. I just want you to know that no recapture can be generated. Likewise, no terminal losses can be generated upon the disposition of these vehicles as well. What is allowed, and what is a little bit unusual, is that in the year of disposition or disposal, there is a CCA deduction allowed. So you can take capital costs, but it's only 15% of what the normal amount would be that you would otherwise calculate. Yeah, a lot of rules. Probably worth spending some time memorizing these rules for Class 10.1. What I'm going to do in this portion of the video is introduce you to the basic capital cost allowance calculation, or CCA. So for the majority of asset classes, you're going to follow a basic structure that looks something like this. Now, what you'll do is start with, this will be your starting point for each one of these calculations, is the opening UCC, or the undepreciated capital cost balance. Undepreciated. Nice handwriting. I know. What can I say? So the undepreciated capital cost is going to be either a balance that's carried forward from the prior year, or it could potentially be zero if there's no assets in the pool, or that class of assets has been completely depreciated already. Your next step would be to add in any purchases made throughout the year, and you're going to, from those purchases, deduct any disposals that were made during the year. Now, disposals are removed or subtracted at the lesser of two different values: the cost, original cost, what was paid for the asset, and the proceeds, or what the asset was sold for. The result of the purchases less the disposals will be your net additions for the year. Now, in order to incorporate the new rules for CCA, what happens now is a little bit complicated. What you're going to see is this net additions amount from up here. You're going to multiply this by 50%, and that's going to be 1/2 of the net additions. Now you're going to add that amount. You will add that amount to your running total already. Add 1/2 the net additions. Now this is going to give you your undepreciated capital cost before you calculate CCA. What you do now is, based on the balance, the running balance that you have, you'll calculate your capital cost allowance and you will make the deduction. Calculation and deduction. The next step, and this might be weird, but I'll do a whole entire video on this, is you're going to, that amount that you added back up here, you're going to deduct those 1/2 net additions, the exact same amount. So whatever value you came up with and you added it on, you will now remove this. The subtraction of this will give you your closing UCC balance, which will also equal the opening UCC balance for the subsequent year. Now, every single line item here is not going to be touched on in this video. You can see I've got the terms recapture and terminal loss here. I'll talk about those in separate videos. Okay, so that probably seemed a little bit complicated, and certainly it was. It was a lot of things all at once. What I'm going to try and do throughout this video is allude to other videos wherein I break down that formula into small pieces, and at the end of this video I'll do an entire problem which brings everything together. So this sample problem is going to be really, really simple. It's sample problem number 1, and it's just going to take a look at the calculation of CCA for a couple of different classes, a Class 8 and a Class 10 asset for a small business owner. So go check out that video and then join back up with us when you're done. That first problem is fairly straightforward, but now I want to focus on some individual elements of this formula. We're just going to keep adding to the formula as we move through the problems. So now we're going to focus on additions and disposals during the year. Additions should be fairly straightforward. We simply add the capital cost of the asset to the UCC pool. Now the capital cost could include any expenditures that are required to get the asset ready to be used in the business. This could be things like, I don't know, freight or foreign exchange charges, installation costs, stuff like that. The disposals are a little different. When we're removing assets from one of these pools, the amounts that is deducted is the lesser of two numbers. One number, the first, is the original cost of the asset. So you're going to need to know the original cost of the asset when you're disposing of it, or the proceeds on the sale of the asset, meaning what did you get paid when you sold the asset? What amount did you receive? So from the UCC pool, you're going to deduct the lesser of cost or proceeds, whichever is the smallest one. All right, the next component of the formula we're going to deal with is the addition of 1/2 of the net additions and the subsequent deduction of those same half net additions. A little confusing? Maybe, but if you can get this down, you're solid gold for CCA. In recent changes to the Income Tax Act, an accelerated rate of CCA deduction is now offered on most classes of assets in the year of acquisition. This rule effectively allows 150% of the normal CCA deduction to be claimed on additions, which kind of complicates our formula a little bit. So how it works is that we have to determine 1/2 of the net additions to the pool and then add them to that pool. Now the net additions are equal to the cost of any new assets during the year less any disposals of assets during the year. Now recall from previous slide that disposals are removed or subtracted from the pool at the lesser of cost or proceeds. It's also worth noting the net additions must always be positive. The value you come up with for net additions must always be positive. That means that if there happen to be more disposals than additions, we can effectively ignore this accelerated rate, and it makes our calculation a lot easier. So once CCA has been calculated and deducted, the 1/2 net additions that we added, they are then deducted from the pool after the CCA calculation. Why did this even happen? Effectively, this rule was put in place to encourage investment in capital assets. See how now if you're going to go and purchase capital assets, you're offered an accelerated rate in the year of acquisition, meaning you get a very large deduction. Larger deductions means smaller income. Smaller income means less taxes. Okay, so let's illustrate what this would kind of look like without any numbers, and then I'll go into an entire example with numbers. How you would implement this rule is that you would start by adding up all the purchases, deducting any disposals or dispositions throughout the year, which will give you your total for net additions. Now, please keep in mind your net addition total, in order to apply this accelerated rate, must be positive. If you have more disposals in the year than you do purchases, guess what? You have a negative amount for net additions, and you can just ignore the entire accelerated rate. Now, once you've determined what the net additions are, you will add half to your pool, like so. Now, adding half of the net additions to your UCC will give you the UCC before you make any adjustments before CCA. You then go ahead and calculate and deduct CCA right now. You remove CCA from the pool. At this point, you're going to take those net additions that you calculated earlier, the 1/2 value, and you added them in earlier, and now you're going to be deducting 1/2 of those net additions. So remove them, get rid of them from the pool. This is going to ultimately result in your closing UCC balance for the year and opening balance for the subsequent year. Let's try and see what this looks like with actual numbers in the following video. Here's the next sample problem I'll walk through. Again, we've got a sole proprietor with a similar year end. They have some carry forward balances, but in this problem, we're going to have additions to class 8, and we're going to have additions to class 10. We'll go ahead and calculate the CCA deduction for this taxpayer in the sample problem number 2 video. Click the link. So here's the narrative for the next sample problem. This sample problem has its own video, like the last few, and we're going to be dealing both with additions and dispositions in this sample problem. So you'll see how the accelerated rule is going to be affected when we have both additions and dispositions. So take a look. We'll see you back here soon. So are there any instances in which we would prorate CCA like we do in accounting? Well, there are a couple. We're looking at specifically taxation years that are less than 12 months. Now, the maximum CCA deduction would then be prorated for the number of days in the shorter year. Now, this happens pretty rarely, but it does happen in the first year of business, and it also happens in the final year of business. So these are situations that do actually arise. How you would determine this is calculate the normal amount of CCA that you would otherwise calculate, including that accelerated rate, and then you would prorate it for the number of days in the year. I've got another problem here that deals with what happens in respect to CCA when we have a shortened fiscal year, meaning you've got the first year of business or the last year of business for proprietorship. So you can go ahead and check that out at sample problem number 4 in D2L. There are a few other areas relating to CCA that you're going to be responsible for. The first one of those things is recapture. What's recapture? Well, this is what happens when we have a disposal or disposition of an asset, and because we're removing the lesser of cost or proceeds from a pool, this is a case where you remove the lesser of cost or proceeds, and it's actually greater than the balance that's in there already. What will happen is you'll create a negative balance. Now that amount is recaptured, quote unquote, recaptured, and included in income. But I talk a lot more about this in my recapture video, so check that out. The next area that you'll be responsible for knowing is a terminal loss. Now, terminal loss happens when we dispose of all the assets in a class and there is still a positive balance remaining. How do we deal with that? Well, I know one way you can find out. Check out this sweet video. As alluded to earlier, Class 12 assets are kind of weird. There's a bunch of different types of assets that fall into the classification or the pool, and unfortunately for us, they're treated a little bit differently. So the majority of Class 12 assets are pretty easy to deal with because they're deducted at this 100% rate. Basically, whatever you pay for those assets in the year, effectively gets written off or deducted in full. However, unfortunately, some Class 12 assets are only 50% deductible in the year of acquisition. Because this is kind of weird and annoying, I made an entire separate video about Class 12 and what we call the half-year rule. So go ahead and check that one out. Boy, capital cost allowance. It's a lot, right? Yeah, it's a lot. So what can you do to prepare? Well, Chapter 3, the worksheet problems, the course pack problems, those are going to be your best friends. You're going to watch those sample videos that I referenced throughout this video that are contained on D2L or on YouTube, wherever you prefer to watch these videos. Knock yourself out. Practice, guys. You need to practice these problems over and over and over again. CCA calculations are actually really straightforward and simple, and students do perform well on them, but only those students who have practiced them. It's a really mechanical formula, and it's something that you can work on and memorize. I promise. So good luck. Good luck out there. Go ahead and calculate CCA on this Lucky Charms car.